Hello.
Can you hear us? Yes. Good morning.
Morning.
Thanks very much for doing this. So fun that we used to write a blog about, and keen to catch up with you and find out what's been going on. So we've got some slides, so I'll just let you sort of rattle through those, I think, first, and tell us a bit about what the trust is trying to achieve, please.
Sure. Okay, so we go to slide 3. So this is just a brief outline of the trust. So it's not a new trust. It's got a new name because of some corporate activity of the investment manager side, but it was actually founded in 1996. So it's got a kind of a long history. We use a refined value approach. So particularly in the multi-asset space, value is quite rare. In fact, across the asset management industry now, there's a lot less value managers than there was in the last cycle, because growth has had such a long and strong cycle. There's a lot less value managers out there, and particularly in the multi-asset space, we don't think there's many people that are applying kind of valuation methodologies across multi-assets. There's a lot more kind of macro, thematic, and maybe growth-orientated strategies, but not many value strategies. I'll go into refined value in a bit more detail later on. The core focus of the trust is multi-asset, and the appointed investment manager as well. Our core focus is multi-asset vehicles, so the specialism of the manager is aligned with the trust. And we prefer a boutique approach, so the business is more of a boutique business. Historically, the old Seneca business was an AUM of around 700, 800 million. We're now in a larger business momentum, but it's still only just over 4 billion is the total AUM. So it's still very much that boutique structure where very investment driven, and the investment managers control their own destiny and build their own frameworks, philosophy, etc. So if we move on to the next slide, I can expand upon what we call refined value. So value is traditionally married up with the equity space, and it's associated with buying stocks that are cheaper than what you believe is their intrinsic value. We've expanded that across multiple asset classes, and again, I'll go into more detail on the asset classes that we invest in, but we're investing across a diverse range of different assets. In every asset class, there's a valuation consideration. So we're never going to be driven by macro, we're never going to be driven by investing with the herd momentum. Every investment will have a valuation consideration, in that we will do a deep dive on our research. We'll form a view of what we think that business, that fund, that portfolio, that investment trust is worth, and then we'll sit and wait. And it may be that the valuation, the share price never comes into our scope, but if it does, then our research is done. It's a company, it's a trust, it's a fund that we like, and we will pull the trigger and add it into the portfolio. We also use our size as well. So if you look at our portfolio, it doesn't tend to look very similar to any benchmarks or the majority of our peers, and that's because we have a lower AUM. We're not a large asset gatherer. We don't have huge vehicles with billions in AUM in particular areas. So we use that size to our advantage, and we will invest further down the market cap scale. We'll use the investment trust market, which again, some of our larger peers can't access for liquidity reasons, and that means that we'll have a lot of interesting investments that maybe are under the radar, so are not well covered by analysts, not well covered by other asset managers, and maybe kind of off the beaten track, and maybe not kind of market darlings of the time. So you should see a very different portfolio than the average manager, I would say. If we go to the next slide. So this is the team. We've got kind of a wide range of backgrounds, but it's the traditional story. The majority of us have worked for larger firms with big AUMs, with house views and house philosophies and house investment processes, and we've made that move to a boutique company, which is the journey a lot of managers do, because as you get more experience, you build up a particular way that you prefer that you should manage money. You have your own view, your own philosophy, and sometimes that can't be applied in a larger organisation. So we've worked for, at my background, I've come from Amundi, which is now I think the largest European asset manager with about $1 trillion under management. Some of my colleagues have worked for Mercer, the investment consultants, large pension funds, wealth managers, etc. So we've all got a diverse range of backgrounds in terms of operating across the industry and the different specialisms, but we share that philosophy of a valuation focus and utilising a low AUM to invest off the beaten track. Next slide. So this one, it's very useful to define our portfolio in a nutshell. So at the top, we have a strategic asset allocation. So what is that? We look at what the objective of the trust is and how can we spread assets across the various asset classes and achieve that goal. So we look at 100-year returns for each asset class if they're available. We appropriate a long-term return for that asset class, and then we diversify across and we come up with an SAA, which again I'll go into more detail in a slide later on. So that SAA is the kind of resting star for where the portfolio is built from. Then we'll have a tactical asset allocation, and we can go above or below that strategic asset allocation where we think we can add value, so we can tilt the portfolio in different ways. And again, I'll highlight the percentage allocations in a slide later on. But the important thing is, what are the asset classes that we invest in, and how do we look at each one? And again, it's very different to what you would see in a traditional multi-asset portfolio or the old 60-40 style balanced portfolios. So we do have elements of that. So we have equity in the form of UK equities and overseas equities, and credit. So there's your old style 60-40 portfolio. But we have the additional specialist assets and defensive assets. And I'll go through each one individually and what decisions we made on how and why we invest in the way we do. So the first one is UK equities. Sorry, could you stay on that? So, yeah, there we go. UK equities. So we invest directly. So we have an in-house UK equity portfolio manager and analyst, and we have a portfolio of around 25 stocks directly invested. You will see that portfolio will be quite different to a normal UK equity income portfolio. I think there's only 2 or 3 FTSE 100 stocks in there. So again, we're using our size to be able to move down the market cap scale. Why are we investing directly with UK equities? Because it's our home market. It's a market we live in, we understand. You can also get good global access via the UK market as well. So we think we can add value by managing that in-house because we have a deeper knowledge. For the other asset classes, we are not going to say that as investment managers, we can be experts or the best of breed in every single asset class, because we just simply won't be able to. You know, emerging market equities, Asian equities, Japanese equities, they're all very different. So we have a hybrid approach where for those other asset classes, we will use third-party managers. Now, yes, that adds an additional layer of fees, but we think giving us that flexibility to be able to move around between managers throughout the cycle, to be able to find the best managers and to be completely flexible and change the portfolio when and how we need to, then that far outweighs the additional cost in terms of your total returns. So hybrid approach, UK equities are directly invested, and overseas credit, specialist assets, and even defensive assets to some degree are all managed by third-party funds. Now, what type of managers do we like? We like boutique managers. We like managers that have a degree of equity in the business, that are benchmark agnostic, that are high conviction, that will be invested in the funds themselves. The traditional characteristics that you associate with a boutique firm, because we think there is a premium to be garnished by having that kind of unfiltered approach and that lack of politics, bureaucracy, protection of AUM that you have in the larger asset gathering firms. There's actually I wrote an article a few weeks ago that's on Investment Week that goes into a lot more depth on that. If you type in my name in the boutique premium, you can read that article, and that'll give you a lot more kind of detail on why we think boutique small AUM managers will outperform over the long term versus large asset gatherers. Specialist assets, one needs to be mentioned, is we use closed-ended vehicles for property, private equity, infrastructure, and what we call specialist financials, which is loans, mortgages, even music royalties fits in there. So it's kind of another. They're all what are normally quite private assets that historically institutional money has been invested in, and that closed-ended structure suits those assets, and you can harvest kind of a liquidity premium. They can use leverage to a degree, and it's a useful diversifier against the traditional equity and credit asset classes. And then defensive assets is a tactical. We can use gold, we can use short ETF sovereign bonds. So when we think markets are starting to trade rich and our valuation models are saying each asset class is quite expensive now and an expensive part of the cycle, we will start to ramp up the use of defensive assets. Next slide, please. So we have a valuation focus very strongly on the bottom up, but on the top down, how do we use our tactical allocation? How do we move between asset classes? What prompts us? So again, with most cases, people will say, well, it's our macro view, it's our in-house strategist, it's our view of the dollar, it's our view of this. We just think forecasting is such a difficult task to do, and it's kind of a zero-sum game. 50% of people will be right, 50% of people will be wrong. And even if you're the most kind of in-tune strategist, then there's always something that's unpredictable that comes along. COVID is one example. The actions of Putin in recent months, again, how do you predict what's going on in the mind of Putin? How do you predict that a global pandemic is going to hit? You simply can't. So what we find is valuation is a much more compelling predictor of future returns. And I think this chart is to me, is the best way of communicating it. So it's looking at the S&P, and it's looking historically forward PE ratios, and on the left-hand side, what's been the subsequent 1 year return. So if you're buying, essentially, there's no kind of correlation there. The valuation doesn't matter because you can't predict what's going to happen over the next 1 year. And we fully support that. We're long-term investors. You can't try and move your portfolio and predict what's going to happen over the short term. If we shift to a 10-year returns, then that graph becomes vastly different. And there's an incredibly strong correlation. So essentially you buy low and your future 10-year returns are higher. And historic data fully supports that, and that's why this correlation is so strong. So we don't ignore the macro. We consider the macro. We use it as a sense check, but it's valuation that drives our asset allocation, which again I think is very different from a lot of other multi-asset funds. And we just stick to what we do. We're patient for long term. Again, that might mean investing against the grain over the short term and buying things that aren't in vogue, but that's fine. We sit, we wait, we buy investments with decent and strong cash flows that can grow, and we just harvest the dividends from them in the short term whilst we wait for this chart, this correlation to come into play. Next slide. So this is how the portfolio looks. So the SIA, you can see on the right-hand column in the bottom left, we do, again, where we're different is we have a tilt on the equity side. So total equity in the SIA is 60%. We have that tilted more to the UK, again, because we think we can get global access via UK holdings if we need to. It's our home market, and we manage that in-house. So if you think about the MSCI world, that will be majorly tilted towards the US. Our portfolio, the equity is much more tilted towards the UK, which has been a strong headwind against us for a number of years with Brexit, etc. But that has kind of now turned in recent months when the Brexit deal's been done. The UK recovery from COVID, even though the initial response was poor, the kind of recovery was quicker, and we kind of seem to be emerging quicker than got. So that headwind has now turned into a tailwind. Where do we stand now? So sorry, maybe the objectives first go at the top is the benchmark is 6% plus CPI over a market cycle. So obviously this year with CPI being as high as it is and inflation as it is, the benchmark is quite an aggressive benchmark this year. But again, we don't look over 1 year. So the portfolio will not change this year because inflation has spiked, and we'll try and chase that, kind of 12, 13, 14% return. No, we won't. This is over a full market cycle. So there'll be times when inflation is low, times when it's high. The portfolio will tick along, and over the full cycle, we believe we'll beat this benchmark, and we have historically. But at times like now, over the next few months, the inflation and that 6% are going to tick away. Markets will do their own thing, and we're not trying to achieve it over the kind of calendar year. Again, where's our allocations? We're underweight equity at the moment, which has served us well because there's been an equity sell-off. We're very much valuation orientated, so we haven't participated in that growth sell-off. And Andrew's news was a great introduction to us because we are value guys. We own some of the stocks that he was mentioning in his including the Gore Street battery storage. So it's great now that the market is turning to, and there's a rotation from growth to value, because we've had that kind of strong headwind against us for 10, 12 years. And now, as with every cycle, it turns, and there's now a rotation back into value. So where are we? We're slightly underweight equity, underweight credit as interest rates are rising, and where we've gone overweight is specialist assets. So infrastructure, property, probably the key examples. In an inflationary environment, our infrastructure, our property investments have really benefited because there's lots of inflation protection in there. Rent have kind of inflation protections in there. Same with the infrastructure, and then the asset values increase as well in an inflationary environment. Then we've got other things like loans. There's a lot of floating rate loans in there, and even music royalties. So hopefully in an inflationary environment, people like Spotify will start to raise the prices, which then trickles down to the music royalty space. Next slide is the income. So slide number 9. Yep. So historically, the income has typically been diversified a third, and a third between UK equities, 1/3, overseas equities and credit, another third, and then specialist assets. COVID then disrupted that as equities really cut back their dividends, but specialist assets has really shouldered the burden. One, we've added more to them, and two, they've sustained the dividends. There's only been a couple of our investment trusts that have actually suspended the dividend, and it was for a very short period of time. Most of them over the period actually grew the dividend. So specialist assets has taken the burden while income has been disrupted on the equity side. And but we'll expect that relationship will start to normalise now. So we've also benefited from that double dip where investment trusts had a wide discount at the bottom of the market as well as the NAV was impaired. So we allocated more to them, so we've benefited from that recovery quite strongly. But that will normalise and go back to a third, and a third. And then at the bottom, the dividend growth. One of the other promises in the trust is we aim to increase the dividend alongside inflation, alongside CPI. So this chart shows we've managed that, we've done it, and it's just dipped behind now at the beginning of this year because inflation is so strong. The board will make a decision on next year's dividend in this month, May. I think it'll be communicated hopefully in the next few weeks. The decision hasn't been made yet, but I would point people to the interims, Maverick's interim accounts. The chairman in his statement does reference it and say, you know, we are fully aware we aim to grow the dividend alongside inflation. And he says 5 years is a reasonable time frame to analyse that. So it's quite a similar time frame to this chart. So he's kind of signposting that it is on the board's mind. So watch the space on the dividend decision over the coming weeks. So if we just go to slide 13, just to quick show the discount control mechanism on 13. So the trust does have an incredibly strong discount control mechanism, which means that the share price does trade very close to the NAV, and the trust will step in and issue shares or buy back shares if it needs to maintain that mechanism. So it's not like kind of one of these ones where, you know, it's the board may buy back shares. There's a really robust discount control mechanism in place there, and it's held up well over the years. I think it was introduced in 2016. And then finally, in summary, which would be slide 19. So we've got a long-serving experienced team. We've got a long history in investing in investment trusts. We've got some very experienced fund selectors on the third-party fund selection side, and then we've got an in-house expertise. So we think by diversifying across all these different spaces and these different sets of specialisms, we can really get a good, strong product with a lot of diversification. We're different with our refined value approach, diverse sources of income and return, and the long-term return outlook remains compelling. I think a lot of if you think about our equity exposure, one of the key concerns at the moment is valuations, and that's why growth has been selling off. Our UK equity trades on a PE of 9.8. Our US equity trades on a PE of 9.9. And then our Japanese is around this. Oh, sorry, Japanese is 9.9 times. US is 9.8 and UK is 9.8. So if you think back to that chart, I should have mentioned it when that asset allocation chart was on. That is where your long-term 10-year return should be very strong. So we've positioned the portfolio, and we continue to position the portfolio at a deep discount to the market. So when more expensive stocks are selling off like they are now, we should be shielded from that because we have limited or no exposure to those type of stocks. And hopefully that's bang on time for my time frame. I think we're going to go to some questions.
Thanks very much, Gary. Yeah, no, that's quite a good roundup of the whole situation. You said that Momentum's got about 4 billion of AUM. How much of that is run in this sort of strategy?
Yeah, so it's probably around 700 million. So we have the trust and 2 weeks and some kind of pension mandates and some mandates as well. So it's approximately a little bit over 700 million.
Cool. And then I suppose the zero discount controllism has definitely sort of worked in terms of keeping discount narrow, but the fund has shrunk a bit recently. Is there a size where it gets too small?
Hopefully not, because I think the tide has turned for us now. So you can imagine we've been value managers. Value performed, value really struggled during COVID. It struggled for the 10 years before that, and everybody wanted a kind of a Bailey Gifford type portfolio with Tesla and tech stocks in it. So the discount control mechanism has stood up. It's stood its corner during that period and has bought back stocks. So yeah, the trust has shrunk, but our performance is strong over the long term. If you look at our 10-year performance, the share price return is 10% per annum. And the NAV over 10 years is 8.6% per annum. So for a multi-asset vehicle, that's really strong returns in a 10-year period of where everyone's preferred growth. So I think, yes, the discount control mechanism has worked and has resulted in a smaller trust, but I think the tide has turned now, and hopefully over the, we'll be doing more, we'll be going out and getting our message across over the coming months. So hopefully that will act in our favour, and we'll start to issue shares over the coming months from here on.
Okay. Just looking at this slide now, so looking at the tactical versus the strategic asset allocation. So you said sort of the value gives you an indication of where you want to be underweight or overweight. How do you actually end up in a sort of hierarchy, saying, well, we'll put more money in credit and less in specialist assets? I mean, how does that sort of determine?
Yeah, so to try and keep it as brief as possible, we take data for 20 years from each asset class. Particularly on the equity side, the data is really good, not so much on the credit side. The credit side, we focus more on yields. But on the equity side, we'll look at US market, Japanese, EM, Asia, etc. Take all of the stocks within that. So let's say there's 20,000 European stocks. We'll take all of those stocks and we'll look at things like PE, CAPE, return, and then some quality ones, return on assets, return on equity, price to book, price to sales. And we'll look at where that asset class, that region or that asset class sits in terms of valuation relative to peers, so relative to the other regions, and relative to history. And then we look at to see if it's trading at a standard deviation above or below its historic average. So that then says, so for example, going in 2020, the US market, and the years before, the US market was trading way above its long-term average. It was trading way above its peers. So therefore, our allocation was low. Right now, credit yields, they're growing at the moment. Credit yields are low, so we have a low allocation, and that's what we look at. So we're looking at valuations relative to peers and relative to history, and then we make adjustments based on that.
And then I suppose there's gearing to take into account as well. So what sort of drives the decision whether you gear the fund or not?
Yeah, so gearing is reasonably static. So the size of the loan remains around the same. So you shouldn't see gearing. Gearing should move between kind of 7 and 12%, and we don't really use it. We're not massively tactical with it. So we did allow it for kind of in the post-COVID recovery. We were our conviction was so strong on the valuations and the recovery of value that we allowed the leverage to go into double digits. So I think it went to 12, 13%, maybe at the 14% of the peak, but realistically, you should see it between a kind of 7 and 12%. So not a huge amount of variation. It's mainly there just to enhance the dividend, to give a little bit of leverage and to just enhance that income flow.
How active is the sort of trading on the fund? Are you sort of rebalancing it once a month or once a quarter, or? So
every day. So we do have target weights. It's not like a quantitative approach where we'll do it on a period. So there's two levels of kind of turnover. There's one is name turnover, which I would say is relatively low because we have a long-term investment horizon. But actual trading may be a little bit higher within the names. So let's say, for example, volatility is high in equity markets and moving plus or minus 20% over the course of a year. Then individual names might be moving 40, 60% over the course of a year. So what will happen is, I think Andrew said before, he likes to drip feed money into the market and do kind of an averaging approach. You will see, as volatility increases, you will see trading increase because some of our stocks will start to or move towards price targets, so we'll trim them back and then maybe exit them as they hit the target. And other stocks will be going below what we think is intrinsic value, and we'll be adding to them. So name turnover, reasonably low. Trading activity is reasonably high because day in, day out, we're looking for stocks that are above or below their intrinsic value, and we will trade appropriately based on what we see.
Okay. Do you try and manage the duration on the credit portfolio?
Yeah, it's deliberately low. Obviously, as value managers, the portfolio as a whole on the equity side, duration is low, and also on the credit side as well. So we have Royal London Global high yield, short duration high yield, Royal London short duration high yield. We have Royal London Sterling extra yield, and we have 24s trust, the select monthly income. So within all of those trusts, duration is low, and our allocation to credits is low as well, relative to history and relative to our SAA.
Okay, thank you. Just looking at now again, back at the sort of income chart again. So obviously there was a big sort of drop in income from equities in 2020. I'm guessing, was the dividend uncovered for a while?
Yes, so for 1 month, I think it was for Q3 in 2020, the trust paid one quarterly dividend out of reserves. So it's well endowed with reserves, there's special reserves, capital reserves, etc. So there's no problem paying out of reserves. The dividend since has been covered. The year-end accounts will be out shortly, so there'll be more detail on information on the dividend going forward. The board were clear with me that yes, there's been an exceptional event. Income as you know, being cut. I think on the FTSE it was about 60% cut in equity dividends. The board didn't want the portfolio to be chasing income during that extreme environment, which was very much the right decision. So it allowed us to focus the portfolio on long-term total returns rather than short-term income. The trust utilised its closed-ended structure, which is what it's there for, to smooth out the income. And we paid 1 quarter out of reserves at the, more or less the peak of the crisis, so, or maybe it was Q3 2020, and then it's gone back to its normal routine.
Okay, thank you. And there's a couple of sort of stock-specific questions. I don't know if you mind talking about
them.
Ahead. Yeah.
Yeah.
One is JLEN. Is it true that you participated in the recent capital raise?
We did.
What was the rationale for that?
Well, JLEN have been quite weak relative to some of its infrastructure peers. I think we've been raising our infrastructure exposure because of our asset allocation. Also, the environment with high inflation, and we wanted more inflation protection. So part of it was kind of a top down, and some of it was a bottom up, that the valuation was a bit more compelling as it had been earlier on. So there's probably a variety of reasons there, some top down and some bottom up.
Cool. And there's mentions of how you got director income, and I suppose that doesn't make a difference really.
We've got what, sorry?
A director income.
Yeah, so the chairman is also on the board of JLEN. Well, that's, you know, there's never any discussion with the chairman on JLEN. Yeah, it's probably a no issue that there's a lot of kind of commonality across boards.
Yeah, exactly. I mean, you're making decisions rather than the board.
Yeah. So the board sees it after the event. We do the trade, and then the board will see it in the next board report and the next transaction report.
Yeah. You mentioned like some revenue. I think do you own Hypnosis and Roundhill, or just one of them? We
own both of them.
Do you have a preference between the two?
It kind of moves over time. So right now, the trust is overweight Roundhill and about neutral on Hypnosis. So Hypnosis buys a lot more kind of newer catalogues, even though that the vintage has been getting older on Hypnosis. But originally, it was a lot more on kind of newer catalogues. Roundhill is very much focused on you know, at least 10, 20 years old. So there's a lot of kind of Elvis Presley and those type of catalogues in Roundhill. The growth in streaming, which is the main driver of returns, has been the older generations, and it's been older songs that have been getting streamed more. The percentage of streams to older songs pre-2010 has gone from, I think, 63% last year to 69%. So the older people are signing up to Spotify, and older songs are being listened to more and more on Spotify. So probably at the moment, I do quite like Roundhill, but the more compelling argument for both of them, rather than stock specific. So the diversified, one's more new and one's older. But to me, it's the asset class, it's the industry. It's moving from, you know, a discretionary spend, people buying records, to a more utility spend where people are paying every month for a spot. So for me, it's the exposure to the asset class that is the main driver. And then there's some differentiation between Roundhill and Hypnosis that we like, so we hold both of them.
Cool. I think we've run out of time, but that was really interesting. Thanks, Gary.
You're welcome.
Good to talk to you again after a while.
Yes,
and
thanks for inviting me.
We'll get you back another time.
Yeah, my pleasure.
And good luck with everything. So thank you for everybody that listened in today. We'll be back next week talking to the manager of Pantheon Infrastructure. It's obviously a relatively new fund, and they've been busy deploying their IPO proceeds. It'd be interesting to see what they've been up to. We do think we've got somebody lined up for 27th of May, but it's not definitely confirmed yet, so we will be telling you what's going on then. Then obviously we've got the Jubilee holiday, but we do have Craig Martin coming on. After last week's session at Vietnam, I thought it might be useful to get somebody to come and give you the proper chapter and verse. So the manager of Vietnam Holding, which is the best performing of those Vietnamese funds, is going to be on talking to us on 10th of June. So thank you very much for listening in, and have a good week, and I'll see you next Friday.